Good morning to one and all. This is Dr. P. Lavanya, working as Associate Professor in MBA Department in Aeronautical Engineering, Dundigal. Today, our topic relates to the definitions and the terminologies which we have been used in the managerial economics. So, mainly the definition terminology what we will use in the module 3, that is production and cost analysis. So, we comes to the definitions of production at first. So, define production. The technical relations which reveals the maximum amount of output capable of being produced by each and every set of inputs. So, here the production means what we want to give output at the end of the day or end of the activity. So, what sort of relationship which was existed between the maximum amount, means what about the inputs what we are using in the production process, that is reveals or gives us the maximum, means the quantity of the output what we are getting. So here these produced or which is having a capability of producing by each and every set of inputs, means as in the production we used to take the inputs and gives the output. So the technical relation existed between the input and output relating to the maximum amount what we derived is defined as production. Next one, define isoquant. The term isoquant itself is broken down in the Latin, which means iso and quantity. So it is called as equal quantity. Means here itself is called as iso means equal and quant means quantity. Means whatever the amount of inputs we gather in order to get the output, so we has to get the equal quantity, means the number of the combination of the inputs irrespective, but the output whatever we want is getting in a desired or equal quantity, we'll call it as isoquant. Define isocost. An isocost line helps to determine the combination of inputs for defining an amount of cost, whereas isoquant curve helps to determine the combination of inputs produced for the same amount of output. Here we have seen that isoquant, iso means equal, quant means quantity, means equal quantity. Now we can say that isocost, where iso means equal, cost means cost, means what amount the organization determined to keep for production of certain unit of goods or certain activity of the production, that we'll call it as a equal cost, the desired cost to be maintained. So this we can see the determination of the inputs with the cost, where it determines the various combination of the inputs where we are able to get the same amount of the output with the same amount of cost. Means inputs and the cost will be equated with what the desired amount of the cost. We'll call it as isocost. Explain cost. Cost is an expenditure incurred to produce a particular product or a service. Means cost we can commonly say as an expense incurred in order to produce any particular product or services is defined as called as cost. Define marginal cost. Marginal cost refers to the increase in the production cost generated by the production of additional inputs. This is also known as marginal cost of production. Marginal, the meaning itself is additional, or we can call it like increased. We can say that marginal means additional or increased. So here the marginal cost means what sort of increased production, then estimated production means the additional units what we have produced, we'll call it as, or the cost involved in producing increased output or additional output, call it as marginal cost. So this could be termed as marginal cost of production. Define opportunity cost. The cost of the next best alternative foregone. Means we also says that opportunity cost is the sacrificed cost. Means what opportunity we lose or we don't attempt, we'll call it as opportunity cost, which we'll call it as next best alternative foregone. So the cost is money or maybe the benefit. Means opportunity cost cannot be called only in terms of money. Maybe it is related to the money or maybe the benefit lost by selecting a particular option during the decision making. Any sort of benefit what an organization has been left or maybe foregone in case of decision making, we'll call it as an opportunity cost. What do you mean by variable cost? The cost incurred to enhance the volume or quality of the production from one level to the another. Means any sort of the cost which enhances or which incurred in volume or quality of the production from one level to the another, where we can say this variable cost is also called as per unit cost. Per unit cost means the cost will changes according to the volume of production or quality of the production. We'll call it as variable cost. What do you mean by sunk cost? Such cost which has been already incurred and cannot be recovered. Means any cost already we have been kept that expenditure but which cannot be come back or recovered back, we'll call it as a sunk cost. Means already happened or existed cost which cannot be recovered. Define BEP, that is break even point. So break even point is famously called as no profit or no loss point. So as analysis of the cost and their possible impact upon revenue and volume of the cost. Means by analyzing the impact based upon the revenue and volume of the firm, hence it is called as cost volume analysis. Means where the organization is attempt to get its original investment. Means the point where organization does not get any profit or any loss. Means the exactly what he has been spent in the organization, that amount coming back point where it has a very good impact or possibly impact upon the what sort of revenue earned by the organization and volume of the firm. Hence it is called as the break even point or also called as cost volume analysis. Describe out of pocket cost. Out of pocket cost could be described or termed as the direct payment of the money may or may not be later reimbursed from the third party source. Means immediate keeping or immediate the expenses has to be done. Means here money will directly give to them. Maybe we have a chance of getting later or may not have the chance of getting later, but it could be reimbursed. Means it will get backed by the third party. Then that type of cost we'll call it as out of pocket cost. What do you mean by margin of safety? Margin of safety, it is also one of the important topic in break-even analysis, where organization after estimation of break-even point, they themselves will see to get how far organization was safe side from the point of not getting the loss. Means the safest part of the organization maybe in the form of volume or maybe in the revenue, we'll call it as margin of safety. Margin of safety, it is a principle which was investing in which an investor only purchase the security when their market price is significantly below than their intrinsic value. Means we can say that it is a safe side where organization invested or an investment made by the investor when purchasing of any sort of securities or any sort of production activity where their market value is significantly below the intrinsic value. Means how far the organization was safe from the loss point, or what amount of the profit does organization is getting above break even, will call as margin of safety. Define PV ratio. PV ratio is termed as profit volume ratio. So in the financial metric, the measuring the relationship between the company's profits and sales volume will termed as profit volume ratio. Means at what sort of volume, for the sales volume, we are attaining or getting the profits. Means how much profits that organization was getting. Means maybe 10,000 sales volume, what is the profit? Maybe 20,000, what is the profit? Means it decides that at what state or what volume condition, what rate of profit does organization was achieving. So this will termed as profit volume or PV ratio. So this is to be expressed a percentage and calculated by dividing the company's profits by its sales revenue. Means PV ratio we can express by saying that a percentage where we can get by calculating the total company's profits by its sales volume, we are able to identify the PV ratio or profit volume ratio. Define short-run cost. Already we know the cost means the expenditure incurred in order to produce any goods or service. So, if that incurred expenditure where the cost itself belonging to the short-term implication, or we'll call it as short period, below 6 months of period, then we'll call it as short-run cost. Means when the cost calculated for a period of very short period. In case of production process, we termed as minimum 6 months. Means below 6 months any production cost was calculated, then we'll call it as a short-run cost. Define cost function. The cost function refers to a function relationship between the cost and output. Nothing else. The cost function is how the cost will be varies based upon its output. Means increased or the decreased of output. Once the changes takes place in the output, the cost will also be changes and its determinants will also be affected. So this is the way how we can define that cost function. Means having a relationship between cost and output and its determinants. Describe profits. The financial benefits that is released when amount of revenue gained from a business activity that is which exceeds the expenses, cost and other taxes needed to sustain the activity. Means profit is purely a financial term. Means whatever we gained above the cost, or maybe we can say when we gained the revenue from a business activity, when the expenses are less and revenue is more, when all types of cost, means the taxes are also be excluded, then whatever the amount we are getting or we are having left over, that will term it as a profit. Means a profit is a revenue when the cost has been decreased. When the cost has been removed, whatever the revenue we left over, we'll call it as profit. 100% for the successful sustaining the business, every organization requires the profit. What do you mean by revenue? Revenue means the total receipts from sale of a given quantity of goods or services. Means revenue is the amount realized by selling of certain amount of goods and services. Means whatever the money we realized for selling of these goods and services, we termed it as revenue. Explain marginal rate of technical substitution. This is famously called as MRTS, marginal rate of technical substitution. Marginal rate of technical substitution, maybe this we can come like maybe for this substitution of taken for two factors, maybe in inputs of production we can consider labor and capital or the two factors. So this is MRTS is a rate at which capital could be reduced for every unit, increasing the labor and keeping output constant. Means the rate at which capital reduces, means one factor reduces and one factor increases, but the output will be the constant. Here when we take two factors like labor and capital, capital is reducing, means decreasing, and labor is increasing. Though these two factors, labor and capital, have a differentiation or change its propositions, but because of this marginal rate of technical substitution, the total output will be constant. Define law of variable proportion. The law of variable proportion is as follows. If a producer increases the unit of variable factor, if the producer increases a unit of variable factor while keeping other factors fixed, means we can say that it is a law which states that increasing variable factor of one factor will be increased and other factors will be constant. Maybe we have in the production like land, labor, capital, organizations of the inputs. With this, only one factor will be increased and all other factors will be constant or fixed. So initially, the total production increases at an increasing rate. Means due to the effect of this law of variable proportion, maybe one factor increased and other factors are constant. At first stage, the total production increases with an increasing rate. Then after that, it increases at a diminishing rate. Means total production increases when all inputs will also increases. The total production will increases when one factor was varying and all other factors are fixed. So first it shows an increasing rate. After that, it will increases at a diminishing rate. Means when I compared with the total production, maybe the production will be less, but when you compared it as increasing rate, means we can't say that maybe we have increased at a first stage 10 units, next 12 units. Now we'll have 11 units. Means when I compare to the above, that is increased production but within a decreasing rate and finally starts declining. Means it goes on 10, 8, so it goes on declining. So this law of variable proportion says that if one factor is variable, all factors are fixed. At first, total production will increases at increasing rate, and at second stage, it increases at diminishing rate, and third stage, it starts declining or decreasing. Explain law of returns to scale. So this law of returns to scale is a long run law where in case of production analysis, it could be explained as change in output takes place when all factors or changes in the same proportion. Means in the long run, where organizations will have a sufficient period of time. So based upon the external demand or requirement, all factors can be changed due to having a sufficient period of time. Means long run means more than 1 year to 5 years. So this organization will have the sufficient time. So all factors are changeable. So this law states that when all factors are changed, Proportions refer to the law of returns to the scale, where it applies only in long run when no factor is fixed. Means here, when all factors are changing, the production will goes on increases, and at a certain place it will have a constant, and after that it will have a decreasing rate. So this law of returns to scale is possible only when it was applicable in the long run and no factor is fixed. Next, Cobb-Ducklex production function. So Cobb-Ducklex production function is only, we can say, like it is also one type of production function, but given by a famous economist, that is Cobb-Ducklex. So the equation provided by a traditional economist, that is Cobb-Ducklex, gave famously called as Cobb-Ducklex production function. So this function is given in alphabetical line. Q is equal to AK into AL, where K is the capital and L is the labor, A is the determinant. These are the two types of production functions which having the benefit and perfect substitutions. Means in case of Cobb-Ducklex production functions, where we can have two factors of production function by comparing or consisting of capital and labor into the consideration, where they are having a perfect substitution of one for the another. Define economies of scale. Economies of scale are the cost advantages repeated by the company when production becomes efficient. Companies can achieve economies of the scale by increasing production and lowering the cost. So where we can say that economies of the scale means the advantages what an organization enjoys when a production was being increased, when large scale production has been taken place. Means it is the cost advantage enjoyed by a company. When due to these increased production, due to these advantages of the cost, the organization will becomes, or the production pattern will becomes very effective. Due to that effective, we can decrease the total cost of production. So these gives the rise to economies of scale by increasing the production, which leads to the decrease in cost. And these economies of the scale, next we'll see what is internal economies of scale. So it is a one type of advantage what a company enjoys by increasing its production. So this type of economies of scale, where it is consequence of the company's size and controlled by its management team, such as workforce, production measures and management. Where we can, in a simple line, we can say like internal factors or internal advantage means within an organization what the company can get the cost advantage or decrease the cost by taking amount or by considering the size of the company and controlling power of the management and workforce of the production, maybe in measurement and machineries. Means internal advantages what a company enjoys due to the large scale production, we'll call it as economies of scale. What are external economies of scale? External, internal means we have said that internal advantages of organization. What is external in the business environment? As we know that internal and external environment. External business factors or environment where are uncontrollable one. So once when we get due to the increase of production within the organization, once an organization has enhanced that outside of the factors are favorable for the increasing of the production and a decreasing of the cost, then we'll call it as external economies of the scale. Means the favorability of the external environment to the production helps in decreasing the cost. Call it as external economies of scale. What are diseconomies of the scale? Diseconomies means disadvantage. So any company, when it goes on increasing the production, sometimes due to the increase of the production in the large scale, organization not only receives the advantage or positive effect, it will also receive the negative effect. So due to this, we can say that some disadvantages a company will get due to the growth of the company or increasing the company's production, such that it takes into the account no longer function for the firm, means the cost per unit will increases. So when the overproduction was increased or the capacity goes on increasing, once again the total cost will also increases and unit cost will increase. So this we can say are the disadvantages what organization get due to the large scale production, called as diseconomies of scale. Define explicit cost. Explicit cost is the actual money and expenditure on inputs or payment made to the outside for hiring the factor services, means any sort of cost or expenditure which actually involves in inputs, means purchasing or gathering for input, or payment will be done outside for hiring the factor of services, means for purchasing of internal input, we'll give the payment to the out of the organization for hiring these services. Next, implicit cost. Implicit cost is a cost of self-supplied factors like internally the expenses occurred in the organization, like the interest upon the capital, maybe rent to own land. Why? Because in the financial management or maybe the accounting, maybe in any organization, everything has to be identified, measured and to be analyzed. So that's why maybe it is our own also, maybe it doesn't go in excluding the money outside also, we should take down the cost. So some cost which were provided for self-supplied factors, we'll call it as implicit cost. What is accounting cost? An accounting cost is a cost based upon the accounting records in the books, means what we'll record in the accounting every day through its ledger, we'll call it as accounting cost. What is a total cost? Total cost is the actual money spent to produce a particular quantity of output, means the internal and external cost, or the direct, indirect, all types of cost together will get the total cost. So it is the, we can say like summation of fixed and variable cost. As we ourselves knows that cost itself could be divided as fixed cost and variable cost. So that's why when we add both fixed and variable cost, then it is called as total cost. Define average cost. Average cost is the total cost of producing per unit of commodity. When the total cost itself, means total cost divided by number of units produced, then you are able to get the average cost. Means it is the total cost of producing per unit of commodity considered as average cost. Define BEP point or break-even point. This break-even point is determined in terms of physical units, maybe in the volume of output, or it could be determined in money value or value of sales. Means here the BEP we can say by taking consideration of physical units, means units produced, maybe volume of production, or maybe money value or sales. So the point where there is no profit, no loss means attainment of original investment in the organization, we'll call it as BEP point. So these are the some of the definitions and words or the terminologies which we are able to get across the cost and production analysis. Thank you.
Like, share and subscribe. Hit the bell icon for more updates.